Good evening, professionals and my dear learned speakers. Today, we are likely to discuss whether in the change dynamics are our companies more vulnerable to be targets for creeping acquisitions or we are likely to be most preferred investment destination. Will India be the next attractive M&A destination or are we likely to face hostile takeovers? Do we need to worry only about China? Is Press Note 3 a double-edged weapon since it restricts inbound and outbound mergers? Due to sizable slump in the share prices, were there few opportunities for non-controlling minority share acquisitions? Do we expect new norms for M&A or changes in RBI norms or SEBI approvals while dealing in change dynamics? Or monitoring agencies to just monitor without proactively making necessary changes to safeguard our jewels? Do we need protection by way of changes in SEBI or RBI requirements? Is it a threat or an opportunity? Will our companies be opportunity ready for supply chain switchovers in the current international wave of hatred against China? To answer all these and many more such questions, we have with us team of experts who will take us for a trip dealing with legal, taxation, economical, strategical, and global political aspects, changes, and possibilities. Representing industry and trade organization, we have with us Mr. Ashish Ved, who is a commerce and law graduate and chartered accountant by qualification, who will deliver his keynote address. By profession, he is a real estate developer and his company Ashish Estates has developed over 5 million square feet in the past 40 years. Incidentally, he is currently my president at the INC Chamber of Commerce and Industry. Welcome, Mr. Ved. Then we have Mr. Arshad Khan, popularly known as Pakku in the legal fraternity, who will share his international experience and global trends in mergers and acquisitions. Mr. Pakku is an executive director with Khaitan and Companies Competition Antitrust Law Practice Group. He is based in the San Francisco, USA, and also operates from New Delhi, India. Mr. Pakku has been the lead or key lawyer on numerous complex merger cases in India, the European Union, and the US. Mr. Pakku is acclaimed for his expertise by publications such as the International Who's Who of Competition Lawyers and Economists, Chambers and Partners UK, the Indian Business Law Journal. Mr. Pakku brings with him considerable global experience in cartel, abuse of dominance, and merger control matters by way of his key involvement in such matters around the world, including in the US and Ireland. Welcome, Mr. Pakku.
Thank you.
We have with us Mr. Ruksat Dawar. He is a partner and head of M&A practice group at Majumdar and Partners, international lawyers, who will guide us with legal framework and changes envisaged in the same. Mr. Ruksat's practice areas are mergers and acquisitions, inbound investments, restructurings, joint ventures, corporate commercial competition, and antitrust and direct taxes. Mr. Ruksat has been consistently ranked as a leading lawyer by various leading legal directories, including Chambers and Partners, Legal 500, Asia Law, IFRLR. He has also been ranked as the top 100 lawyer of India by the Indian Business Law Journal. Welcome, Mr. Dawar, who is my lender of the last resort and savior today. Thank you, Mr. Dawar, for accepting my last minute invitation.
Thank you so much, Manoj.
Then we have Mr. Vivek Gupta, partner and national head, M&A Tax, who has over 25 years of experience across corporate mergers and acquisitions and private equity transactions, as well as business reorganizations, domestic as well as multi-jurisdictional, having participated in a number of cross-border and domestic transactions. He has been regularly ranked as one of the leading M&A advisors in India in the ITR rankings for India. He writes for the financial newspapers and is also a regular contributor to various current affairs and news shows on the electronic media. Welcome, Mr. Gupta. For transactional advisory, we have with us Mr. Nishal Joshipura, who co-heads the private equity and M&A practice at Rishi Desai Associates. He has designed and implemented some of the most innovative structures for M&A and private equity deals in India, and his structures have been consistently recognized as most innovative by Financial Times and RSG. He has been recognized by Who is Who Legal 2020 for his contribution to the field of private equity in India. He has been highly recommended by various legal directories for legal and tax advice on M&A, private equity, and investment funds. He was nominated as a Young Achiever at the Legal Era Awards. Welcome, Mr. Joshipura. We have another Mr. Gupta, who is the founder and managing director of Stakeholders Empowerment Services, and who will discuss mainly from the overall economy and regulators point of view. He has over 37 years of diversified professional experience in public and private sector, including 2 terms with SEBI. He was executive director with SEBI. Mr. Gupta is also a member in the various committees such as Capital Markets Committee of CII and SOCM, Secretarial Standard Board of ICSI, Chairman of Task Force for Audit, Due Diligence, Compliance of SEBI laws constituted by ICSI. He is member of Corporate Governance Committee constituted by SEBI. Welcome, Mr. Gupta.
Thank you.
May I now request Mr. Ashish Vaid to deliver his keynote address, please? Over to you, Ashish, sir.
Thank you, Manoj Bhai. I must thank Bombay Chamber of Commerce, Vijay Srirangan, and also the WIRC of ICAI, that is Western India Region Council of the Institute of Chartered Accountants, for hosting this event this evening. And what a galaxy of speakers you've got, Manoj Bhai, and hats off to all of you for for making it convenient to attend in these tough times. Especially, I would like to compliment Mr. Arshad Khan that when he was just speaking before the meeting. It's like 4:30 in the morning in the Bay Area, and he's kind enough to have woken up to address us all. So thank you very much, sir, and of course to all the other panelists, a big, big thank you. These are indeed very, very tough times and very interesting times too, and a lot to learn. Times which you see once in a century, as they say. Last was the pandemic of the probably the Spanish flu, and followed by the World War II, and now here we are facing these tough times. So there's a very nice WhatsApps going around, which you may have seen today. There was one going around where one father is telling his children, reading to his children, and he says, "This happened in 2020." So we are living through it, and maybe we will someday tell our I would say grandchildren, at least at my age, because my children are also facing it at age 25. So I'm not so technical as a lawyer as all of you are. So I will just like to give a few remarks. Basically, the topic of today, is Manoj Bhai, what a long title you've got for the event, which is now new norms of mergers and acquisition as predators arise, abuse of dominance and creeping acquisition. Change dynamics. My God, that's really long, but very well. But I guess it's the flavor of the season, or flavor of the day, or flavor of the year in India, especially. So I would like to just mention how China has without going into any controversy, I want to just mention how when we thought that when this pandemic broke, and everyone thinks whether it's lab driven or whether China hid the fact or what, we do not know the truth. But having said that, when all the stock markets in the world have crashed, India by 50%, almost America by say 33%, and only China was like had fallen about 7%. So when India fell, and we came to know, the news broke out that that one of the South China Bank is acquiring HDFC stocks, and they in fact acquired 1% of the stock. So I think it was very creditable and incredible that our government acted very swiftly and came out with the MHA circular. And in this circular, they mentioned that very guarded circular, which obviously, but it was quite obvious. It says that any country which shares a border with India, those countries will not be in the automatic route, but they will have to take the permission, explicit permission from the government before investing in India. So this is how we have tried to, let's say, prevent this creeping acquisition, so to say. I also recall, as talking of China, I would like to just give a different flavor to the whole thing of creeping acquisition. You know what they are doing, as we all know, that this the president, Mr. Xi Jinping, since 2013, has got this um, I mean, absolutely wild idea of this Belt and Road Initiative, which he has promoted. And in a way, it can be called an acquisition route in a way, because what he's done, as we all know, and this his plan is for this full century. He feels that he'll complete it at the end of this century. And he wants to connect Asia, Europe, and Africa by road. And what he's trying to do is take advantage of the weaker and emerging economies and which are debt ridden, and they have so much debt that he's trying to bail them out all the time, and they'll become indebted to China, and then they will take advantage of them, which is an obvious game plan. It's a big game plan. We don't know if he'll succeed, but at the moment they're going great guns and have already put like billions and trillions of dollars in the scheme, and it's an ongoing process. Thirdly, like in mergers and acquisition, there was a very interesting one which happened a few years ago, and I think the panelists would all remember that, was the L&T story. So L&T was a company which was doing extremely well, Larsen and Toubro, and it was set up around 1938 in India by Mr. Larsen and Toubro, and by two people. And what happened was, unfortunately, this engineering giant did not have their holding in the company was very low. So it was mostly publicly held. And taking advantage of this situation were these rich uh, boys or whatever, gentlemen or businessmen from Dubai in 2001, the Chabaria brothers, you all may recall, and they made an acquisition of the company. And then they sold out to the Ambanis, and Mr. Dhirubhai Ambani held it for a long time before he sold it to Mr. Kumar Mangalam Birla in around 2010, I think. And that's when Mr. Nayak, I was just reading his book, Mr. A.N. Nayak of Larsen and Toubro. He came out with a great idea, and he wanted to save the company from becoming privately held, so to say, into a private hands. So he came out with the idea, and he approached Mr. Kumar Birla and said that, look, we'll divide the company into the cement division and into the engineering division. And he took over. So what they did was the cement division shares were all sold to the Birlas, and they took the engineering section. They formed the Employees Welfare Trust, which held all the shares. And then the rest is all history, how L&T has grown and grown and grown and doing all the massive infrastructure projects in India. So that's another very interesting thing. Also, I would like to say that you know, the new IBC code which has come in India, and that gives a lot of opportunity to people to acquire companies at good valuations, because when they are not able to pay bank loans back, they get these companies go to NCLT. The debt is written off, kind of story, because it's an auction process, and they can acquire these companies at good valuation. So with these two sort of examples and words, I would like to throw it open, because we have a very, very illustrious panel. And thank you, Manoj bhai, once again for inviting, and have a good conference. Thank you so much.
Thank you very much, Mr. Ashish, for your wonderful speech. Uh, May I now, without we taking much time, request today's moderator of the session, Mr. Paku, to take over all the way from San Francisco. Thank you, Mr. Ashish.
Thank you so much, Mr. Vaid. Thank you so much, Manoj. And thank you, ladies and gentlemen, for this opportunity. As both Mr. Vaid and Manoj said, it's around 4:50 in the morning in the San Francisco Bay Area, where I live. I was in India for several years, from 2010 to 2016 at Ketan & Co. in New Delhi. But I moved here about 3 years ago, originally American by birth. This is an area, a topic of real interest to me. When Manoj asked me to do this, and as Mr. Vaid so articulately pointed out, it's a very long title, but it's a very interesting title for the new normal of today, and that's new norms for M&A as predators arise, abuse of dominance, and creeping acquisitions and change dynamics. And we're going to talk about change dynamics in the beginning here, because that's really the context in which all of this is taking place. I was just joking with my colleagues on the webinar just a few minutes ago that it's not often on a Saturday night where you all are at that we can talk about such things as M&A and creeping acquisitions. But this thing, frankly, this horrible thing called COVID-19 has brought us all together in perhaps a way that the world has never been brought together. Even in World War II, for example, the United States was pretty much immune from the war, although all meaning from attack besides Pearl Harbor. But this is something that covers all of us, and we're all in it together. I think it's actually the first time that there's been an event like this in all of our lifetimes where we are all essentially facing the same things. So we're here today to talk about what that entity, what that thing called COVID-19 is going to do to mergers and acquisitions in India. The title of today's webinar raises a lot of issues. And the first one is the words changed dynamics. So I'd like to ask my colleagues on the panel today, what are these change dynamics in India as it relates to M&A? In other words, what sectors are most likely to become either M&A targets or M&A buyers because of the ongoing pandemic and the consequential economic downturn? Panelists? Vivek, we can't hear you.
Vivekji, you are on mute. Vivekji, you are still on mute. Sejal, can you please help? Sejal Ben.
Who's that?
Mr. Vivek Gupta.
Yeah, Mr. Vivek Gupta, yes.
Please, sir.
Vivek, unfortunately, we can't hear you.
We can't hear Vivek.
I think you need to just increase the volume on your device, maybe.
In the meantime, can I impose on Mr. Jayan Gupta to maybe give some of your thoughts while we try to get Vivek's sound fixed?
Vivek, sorry, I have to go ahead because your audio is not working. Okay, see, Mr. Khan, that's very thankful of you to asking this question to me. Now, I would say that let us see what is the difference first.
Can I go on mute for some time? Hasana? Ramesh bhai no phone I got. Ramesh ji no.
Okay, it is not the first time the stock markets all over the world have fallen. We had a crisis in 2008, and at that time we never discussed this question. So we got to get to the root. What is the difference this time which has necessitated this? So I would say that following are the basic changes that have taken place. One is that world over everybody has realized that too many eggs in one basket or over dependence on one country is very, very difficult. So that means people are thinking that we have to have an alternate to Chinese. The second thing is this, that people have realized that whatever business continuity plan you had prepared earlier, they are all useless because you forgot one thing, that something like this can happen in the world. That whole world can be under lockdown. So in those situations, how do you have your business continuity? Third factor is this, that today you have got, although there was some sort of doubt was already there, but the doubt has become more accentuated on the China's secrecy and whether the China is the partner which people would want to have a long term or not. So these are the three basic changes that happen over as compared to any other stock market fall, because the stock market fell about 50% in 2008 to 2009, but we never discussed. So let us come to all those things. So what I feel is this, that all over the world, capital allocation from the investors who have got money would change, and capital will flow not to one concentrated thing, it will be diversified. The second thing would be that people will be always trying to develop alternate channels of sourcing and supply and will not be dependent on one or two countries anymore. Now, coming back to all these factors and what is going to happen in India. So, India has a tremendous opportunity at this juncture to encash, provided we play the game right. Now, what is going to happen is this, that if you want protection in India, I think the protection has to be there. But then protection, you cannot have the protection through the press note 3 only, because you do not know where, from which entity, what is the final beneficial ownership. So let us forget about that. Now the issue is, are we going to protect the Indian entrepreneurs from takeover, or we are allowing the foreign parties to come in India? Now, in normal situation, I think as India has been doing for the last 15, 20 years, it is an open economy. Anybody can come and invest, and anybody want to do something. Then the situation is, with the stock market prices at low, can you allow anybody to come in and take over your company cheap? I think if I have to speak from the Indian entrepreneurs side, I would think it should not be. But what can you do? Can you do something that you cannot allow any foreign investor to purchase equity? I don't think that can be allowed, because that will be a very retrograde step. We have already traveled 20, 30 years in the other direction, and we can't go back. So the idea is to see how we can facilitate merger and acquisitions without hurting our entrepreneurs. Because today, if you hurt your entrepreneurs, it will be a very long-term impact. So one method I could see is this: allow Indian entrepreneurs in all those companies where they have got an equity which is very susceptible to be overtaken by another thing, so they can be allowed to boost their equity in their own company. The second is that allow a little bit more leeway in the joint ventures or investment into companies where the ownership could be shared, and many more things can happen. But the very thing important is this, that one has to see that this is a different dynamic, but a word has changed. I don't think in 5 years from now you will find that any country will be dependent on any other country in that manner in which it is today. So India has tremendous opportunity, because yesterday I was reading that API industry, where India was a dominant player about 15, 20 years back, had almost shifted to China, and India is now dependent on China for API. So I think all those corrections will change, and maybe many more companies will come to India for such things. I would end here, and I will ask Vivek to, I hope his audio is working now.
Still no.
Yeah, it's working now. No, it is gone now.
I can't hear Vivek. No. Vivek, are you able to call on your telephone into the webinar?
Mr. Vivek, can you please pick up my phone? I'm trying to call you up.
Meanwhile, Mr. Khan, can you continue?
Mr. Khan, we can't hear you, Mr. Khan. Mr. Khan, we can't hear you.
No, we still can't hear you. Mr. Khan, we can't hear you. No, we cannot.
Mr. Vivek Gupta, we are working on it. So in the meanwhile, if you can proceed.
Manoj bhai,
Haji,
in the meantime, can you just
Haji.
ask the next question while we wait for this?
Yeah, but Mr. Khan is not in a position to speak. I think we can't hear him.
It's saying that I was muted by an organizer. It's now been
Okay,
unmuted.
now we can hear you.
Okay, great.
Yes,
So,
now
We can hear
yeah,
you.
okay. So everybody, apologies for the technical issues here. Mr. Jayan Gupta, thank you so much. And Nishal and Rukshad, just your thoughts as well on what we mean by change dynamics. How do you think that these change dynamics at a very macro level are going to change M&A as it relates to India, both domestic and international?
Sure. Can you hear me?
Yeah.
Yes, yes.
Yes, sir.
Okay. So I think the way I'm looking at it is, cash is going to be the king going forward. And the most important thing that India will need to tide over the COVID crisis is going to be capital. Now, there are two sources of capital as far as India is concerned. The first one is the government pumping in more money in the form of stimulus packages. And the second is going to be foreign capital. Now, as far as foreign capital is concerned, and I'm focusing more on private equity here, as on December 2019, we had about 2.5 trillion of dry powder available with foreign private equity funds for investment in portfolio companies across the world.
Nishal, could you turn on your camera as well? Sorry.
Yeah.
Okay, thank you.
So as on December 2019, we had about 2.5 trillion worth of dry powder available with global private equity funds for investing and acquiring portfolio companies across the world. And out of that, about 800 million worth of capital is just for buyout of companies. So clearly there is huge amount of capital that is available. And the next big question which arises is global capital for India so that we are able to tide over the COVID crisis. Now, people have been saying that a lot of companies are looking at shifting their manufacturing base from China. But I think the biggest mistake which India can do here is assume that the next destination from China is going to be India. That's not going to be the automatic answer. There are other countries like Indonesia, Philippines, Poland, who are also vying for some of these businesses to shift to their countries. And which is why I think in addition to ease of doing business in India and ease of living, somewhere the government needs to come out with policies for ease of bringing foreign capital into India. And if you see today, the processes and procedures that a foreign investor has to go through for investing in India are very cumbersome. And just to give you an example, let's say there is a foreign distressed PE fund which is sitting on $1 billion of capital and wants to acquire non-performing assets from Indian banks, right? What all things the foreign investor has to go through? The first one is the foreign investor has to set up a foreign portfolio investor entity. That entity needs to then find an ARC in India to partner, so that through the ARC they can buy the bad loans. And that entire process is so cumbersome. It takes about 2 to 3 months for this entire process to go through, and which is where the simplest thing which I would ask is, why can't a foreign investor is sitting on $1 billion cash? Why can't they directly purchase the NPS from Indian banks? Why can't we frame policies to protect whatever needs to be protected, but smoothen the processes which are required to be followed for acquiring some of these assets? I think the second major thing is the deal timelines, and this is something which has always bothered me as a lawyer, where for large deals in India, 6 months is the minimum, and we have seen large deals going on for 24 to 30 months for consummation. Now, why is it so cumbersome? Why does any merger or demerger with NCLT take about minimum 6 to 9 months for NCLT to clear it? Why can't all these things be done in a month's time? What's the rocket science that they take 6 months to 9 months to go through some of these things? So if you see in US, all the major deals get consummated in 3 months time, right? It could be even 30, 40, $50 billion deal, but in 3 months time, pretty much on an average, the deals get done. So somewhere we need to just go back to the drawing board and see how to give confidence to foreign investors to invest foreign capital into India, because ultimately it's not an automatic route, as I mentioned, where Chinese investments will come to India. We'll have to make ourselves eligible to receive those investments, and that can come only when the confidence is there that the processes are going to be simpler, the approvals are going to be simpler, and India is going to be an attractive destination without any flip-flop on the regulatory and tax policies. So that's my take on the what's going to happen on the COVID front.
So I think, this is Rukshad. So what I would like to add is that given the in the wake of this virus and the scenario post this virus, and also in the current time frame, I think in my view the M&A dynamics will change considerably, in the sense that valuation and liquidity would be the key drivers for M&A activity in India going forward. Always the buyer will now look at with a microscope on what value the buyer is going to get out of the deal, and well, we are going to see a lot of refinancings happening, given that we are now exposed to a lower cost of capital in deal making. So historical debt will be substituted by new debt at a cheaper rate. Also, what we have understood to be a seller's market earlier is now clearly moving towards being a buyer's market. And in the light of all of this, I feel are going to face immense pressure and immense difficulty in getting capital, and because people and more organized players are going to look at companies which are already established with a positive cash flow and all of that, So also, as I mentioned, the key positives are that now reduced cost of capital is available, and the valuations are more realistic in order to kickstart the M&A process, both globally. I mean, in terms of global deals having an India presence, as well as a pure play domestic M&A activity. I also feel that on the deal making side, on the M&A bit, is that we are going to see an increased focus on rep and warranty insurance, and a narrowing of indemnity obligations between parties going forward. So I think it's in my view there is it's an opportune time for the Indian government to consider having a bit of a protectionist regime. I'm not saying that it should be very protectionist in terms of screening abundantly investment proposals that are likely to threaten the security interest of India. So something like the CFIUS authority that the US has in place in terms of being a nodal authority to oversee any inbound transactions coming in and to scrutinize that. So I would say that it's not only, I mean, in terms of China, but also where we feel that companies or hedge funds or even funds which are kind of not having a reputable character and those who are seeking to invest into India and possibly which may cause some threat in terms of not only in regulated sectors but also unregulated sectors. So I mean, where say investment up to 100% is foreign investment is permitted in technology companies, but what if personal data is misused? So those are the checks and balances that the Indian government needs to put into place to ensure that we have an healthy regime going forward. So all in all, what I feel is that the landscape for M&A and deal making is going to change considerably, and being historically a seller's market, it has rapidly moved now towards being a buyer's market. That's
All
from
right,
my side.
Rashad and Nishal, thank you so much for that. Vivek, do we have you finally?
Yes, hopefully. Can you hear me now?
Yeah, we can hear you.
Yes,
Fantastic.
perfect.
Fantastic. Lovely.
Okay.
Lovely. Okay, so I will go back to Baku. I will go back to your first question. In terms of the question that you asked was, what sectors are most likely to become M&A targets or buyers because of the pandemic? So I think you set the context beautifully by saying that life is not going to be the same again on Deal Street. And the way I see deal activity is I actually divide India into three broad types of sectors. So, if we see all around us, there is a small subset of sectors that have actually gained from the pandemic induced behavioral changes, and I count entire digital space, whether it's Zoom or GoToWebinar or any of the anything that is delivered digitally. So the entire digital space, e-commerce, online education, edtech, those are sectors. That is a small subset of sectors that have actually benefited from the pandemic. So that's category one. Category two is another set of sectors where I think the impact is behavioral, and therefore the impact will be medium to long term. These are sectors that have gone completely zero revenue, more or less, right now. But I see that even when they recover, there will continue to be behavioral impacts on these sectors. This would include, let's say, travel, tourism, aviation, hospitality, leisure consumption, food, restaurants, etc. So I think these sectors will take 24 to 36 months for the world to forget these lockdowns, if the world does indeed forget these lockdowns. And then the third subset, in my mind, will be the other vast majority of sectors which have lost demand now or are suffering, let's say, supply side disruptions now with the lockdown, but which, when the world returns to normalcy, will come back to normal without there being a dramatic new normal in them. So I would say in the next 9 to 12 months, hopefully the pandemic goes away completely, and therefore these sectors come back to normal. So with these three sectors, what does this mean for M&A? In the first, I think we will continue to see happy market deals. We will continue to see normal transactions of the kind that we see. We will see high valuations. I'm right now part of a number of processes in these sectors, including gaming, etc., where private equity investors or strategic investors continue to want to invest. So I don't think we will see any dramatic change in category one. which are effectively the sectors that are benefited by the pandemic, and therefore I call them fair weather, happy time deals. So happy time deals should continue there. In the second sector, I think it's going to be pretty dicey. We've already seen bankruptcies being filed globally. India is talking about delaying or suspending partly the way IBC functions. So in the second space, I think we will see deal making, but we will see deal making of the unhappy kind. We will see distressed financing happen. We will see bankruptcies happen. And the only happiness that we will see in this sector is if potential consolidation occurs. Two hotel players get together, two travel players get together, etc. So the second space is what I call unhappy deal market, distressed financing and bankruptcies being the order of the day, and some potential consolidation. The third space is actually the space which will be most interesting. I think their asset-light businesses, which don't suffer balance sheet overhang of debt, etc., those players will be very strong. They will come back very strongly. I think there's an opportunity to pick up stakes at current depressed valuations in those sectors, and those are the sectors which should either need protection because people will be looking out for deals at this time, or those are the sectors where the non-debt ridden players will be able to ride out the storm and come back stronger. So in a sense, I would say I remain bullish on the M&A market. I see a significant drop-off of activity in the near-term future as investors grapple with the uncertainty arising out of COVID. We were on a call very recently with a bunch of private equity houses, and I think what we were hearing was, if there is a business that we can't model and we can't prepare a financial model for in the crisis, we're not really interested in investing in that business, even if the recovery is V-shaped. We're also hearing potentially recovery will be U-shaped, and some of them were even saying bathtub shaped, right? So while I see a significant drop-off of activity happen right now, I do see M&A re-emerge 9 to 12 months later in the three baskets that I spoke about.
Vivek, thank you. That was excellent. And panelists, thank you so much for setting the stage for the context in which we talk about M&A in India, both domestic and international. So now let's turn to something that Mr. Vaid and Manoj talked about briefly. And let's get into the heart of this thing called Press Note 3. I'd like our panelists to tell the audience, what is Press Note 3? How does it work? And who, besides perhaps China, was it intended? And is China the only issue that India needs to be concerned about? Panelists, over to you.
So this is Rukshad. So Press Note essentially mandates foreign investors from a country which share land borders with India to take prior approval of the Indian government for FDI into India. So the FDI nomenclature would cover any investment or transfer of equity instruments of an unlisted company, or 10% of the post-issue paid up equity capital of a listed company. While, as we all know, that while the press note applies to all neighboring countries, it is obviously a focus towards curbing or regulating investments from China, and this has been really taken up on top priority once the HDFC investment by the People's Bank of China was announced. Of course, there are other moral and humane grounds also to back the origin of this Press Note 3 that has come into being, in terms of widespread allegations that against China, that they have failed to play their part in flagging out the COVID-19 pandemic in early days, which could have mitigated the spread and saved several lives. Also, I think India-China relations have always been sensitive. So there are valid national security concerns behind behind this press note. So what the consequence of this press note would be that any investment, like even one share, or even if the ultimate beneficial owner is of Chinese origin, those investments are not going to be through the automatic route, and they would require the approval from the government of India. Certain lacunae, of course, they need to be ironed out on the press notice in terms of beneficial ownership. What's the definition of beneficial ownership? What's the percentage criteria and all of that? So that remains to be seen how the government clarifies all of that. But the intent is that even if right through the value chain up, if there is a trace of a Chinese investor, then those investments are going to be looked at by the government of India. And this is also following an important trend where a lot of countries are talking about this entire pandemic and their issues against China. So I think also because of pinpointing towards China as being possibly the cause of this widespread pandemic, people are looking at tightening their norms for effectively having Chinese companies to go down the government scanner for investments into those respective countries.
Thank you, Rukshad. And Nishal, do you have any thoughts as well on press note 3?
Sure. So I think the clearly, just like social distancing is being propagated by the government, this is a classic example of economic distancing from countries with which the government of India is not comfortable with, who can take advantage of the depressed stock prices for some of the Indian companies. So if you just to give you an some data, out of 538 stocks from BSE 500 and Nifty 500, the stock prices for 114 companies fell by more than 50% in the last 1 month, and stock prices for more than 221 companies fell between 30 to 50%. So almost 65 to 70% of the listed companies in India have seen fall in stock prices from 30% to more than 50%. And in this background, the government came out with the press note of obviously what was told about People's Bank of China transaction in HDFC. And actually, there are 2 more Chinese acquirers who are already looking at more opportunities. The Industrial and Commercial Bank of China and China Investment Corporation. As we are speaking, they are scouting for investing and acquiring companies in India. So with this background, the press note was issued, and I think whether we like it or not, and it's not something to do with COVID, but the process of reverse globalization had started more than 2 years back with President Trump imposing tariffs on Chinese companies, and I think the entire world wants to now look inward and protect the domestic economy. So it didn't come as a surprise that Indian government also wants to do the same thing. As far as the ambiguity is concerned on the concept of beneficial ownership in the press note, the way I'm looking at it is something that the government is enjoying right now, and I think it has been purposely done. I don't think they have missed out clarifying what is beneficial ownership. They want to keep it ambiguous, and they want to see how things unfold over a period of time, and that's where I think this is going towards. Now, at least the way we are looking at it is, while direct investment of even 1 share is going to get covered, I think it will be very weird and awkward to even consider less than 1% Chinese LP in a global fund as a beneficial owner for the purpose of press note 3. And hence, at least if you see the beneficial ownership definition under various laws in India, I think there are 5 or 6 laws where beneficial ownership has been defined. The first being the master direction on know your customer, which RBI had issued. We also have the Prevention of Money Laundering Act, which is the PMLA definition of beneficial ownership. We have a significant beneficial owner definition under Companies Act. There is a definition of, not definition, but through jurisprudence, beneficial ownership has been defined by courts under tax laws, and even under the Benami laws, there is a definition of beneficial ownership. Now, if you see and take the strictest definition of all, right, while the intent of the Press Note 3 looked as if it is more to do with Chinese companies taking over control of Indian companies, but the way the text of the Press Note and the NDI rules, the way it has come out, it also includes even minority investments of even one share in the Indian company. But if you look at this definition on beneficial ownership under the IOS, I think the most logical way to look at it is that if a Chinese LP is owning less than 1% in a global fund, then that fund should not ideally be required to take approval for investing in India. Otherwise, it's going to be a nightmare for India to attract more foreign capital. And the other thing I think the government should do, and this is in line with the same concept of ease of bringing foreign capital into India, I think there should be a fast track approval. I mean, one is Press Note 3, we have talked a lot about this, but if there is some investor like let's say an Alibaba or ByteDance, if they want to invest, you have a checklist of all your security concerns that you have, but clear their applications fast or reject it. Don't sit on it for months together in a manner where it frustrates the foreign investor. So that's one. Similarly, there are a lot of Asia funds of global funds. So if you look at let's say big funds like KKR or Carlyle's of the world, a lot of them have Asia fund. Now in these Asia funds, typically you will have higher investments from Chinese investors, right, compared to global investors. And I think somewhere it needs to be made clear on what are the exceptions that need to be made. For example, if there is a rights issue where the fund is not increasing its stake but is making investment, then there is no reason why this Press Note 3 should apply. Similarly, if there is a bonus issuance of shares, then why should this Press Note apply? Similarly, for FPIs anyways, SEBI hasn't come out with anything, which means that below 10%, as of now, they are not worried. They may come out with something. But I think somewhere it needs to be thought through properly. And but as I mentioned, looks like the government is enjoying the ambiguity right now, and which is why they are not coming up with any specific definitions on beneficial ownership. And they want to just see how things unfold and then take a call. So that's my take on Press Note.
All right, thank you, Nishal. And I think both you and Rukshad anticipated my next question about how much is too much when it comes to a creeping acquisition, what quantum of share acquisition is going to get the interest of the regulators. So I think you've done that quite well. Why don't we move on to another topic here, given the consequential financial, let's be honest about it, downturn that's going to be happening both in India and worldwide. Do we anticipate that there's going to be an onslaught of hostile or unsolicited takeovers, especially where companies are in a weakened state? If so, can you just walk us through how these hostile takeovers are actually effectuated? And is there anything that a weakened company can do to defend itself from a hostile takeover?
So maybe I can take it up and other panelists can fill in. So I think hostile takeovers in India, haven't been a great success in the last 30 years. Having said that, we have about 3 successful hostile takeovers in India in the form of L&T Mindtree, Imami, Zandu, and India Cements acquisition, Rasi Cements. And there were 3 attempts for hostile takeover that were made which didn't turn out to be successful. One was, I think, the keynote speaker mentioned about Birla's acquisition of L&T. So in fact, L&T has to its credit both hostile acquisition of a company and also being able to defend or thwart a hostile bid. So that's to the credit of L&T. I think the other one was Swaraj was acquisition of stake in DCM and Escorts in 1983. That was also an attempt, but the government somewhere had to intervene, and he had to sell the stake back to the founders. And the third one was Abhishek Dalmia's acquisition of Jesco, where again there was a white knight in the form of Mahindra who came in, and they managed to thwart the bid. Now, why do hostile acquisitions take place, and what are the best conditions for hostile acquisitions to take place? I think 2 or 3 things. I think one is, smaller promoter stake, which is what we saw in Mindtree. The promoters are only owning about 13% in the company. So a smaller promoter stake is a classic condition for hostile takeover. Second is the institutional shareholders of the shareholders and the lenders to the company. If the hostile acquirer is able to get their confidence, I think that's another condition, I would say, which will be helpful for hostile takeover. Third is there have been situations where there are 2 groups of promoters in companies who are warring with each other. And if you are able to get one group of promoter to side with you, then that's a third condition where you can do a hostile takeover. And this is something which happened in Imami's acquisition of Zandu, where the family sold their stake to Imami, and finally the Parikh family, which was the other promoter group, had to sell their stake to Imami. So that's another one. And I think generally the way things happen is either of these 3, or what is called a toehold acquisition, where the hostile acquirer also keeps buying certain shares from the market to increase the stake, in addition to partnering with the promoter. So broadly, these are the fit or ripe conditions for hostile takeover to happen. Now, on the other side, as far as takeover defenses are concerned, as to what should be done by the Indian companies, listed companies, to thwart the hostile takeovers, right? Now, globally, there are many takeover defenses which are there for protecting their companies. And if you see, lot of US companies have already started introducing poison pills in their charter documents in the last 1 month. The classic example is Groupon, which is an online deals making company, where they introduced a poison pill in their articles of association, which stated that if any acquirer acquires more than 10% of Groupon, then all the existing shareholders of Groupon will have the right to subscribe to 1 share for every 1 share that they hold at 50% of the market price. So what this does is that in case the poison pill gets triggered and the shareholders subscribe to the shares of the company at 50% of market price, the company's valuation of the new shareholders are getting shares at 50% of the market price. And some of these things have already started. In fact, in India also, we are working with a few listed companies to see what poison pill can be introduced in the articles of the company to thwart hostile takeovers. On top of that, some of the international takeover defenses unfortunately do not work in India. So like, for example, the buyback of shares at a huge premium is something which becomes a challenge in India, because under regulation 26(2) of takeover code, the target company is not allowed to take any buyback without getting a special resolution from the shareholders of the company. There is a concept of staggered board internationally, where you can stagger the resignation of directors on the board over a period of time, which the hostile acquirer cannot change. But in India, as we know, more than 50% shareholder can remove the entire board as per the Indian Companies Act. So that's something which which doesn't work. Similarly, there is a golden parachute concept internationally, where if there is a hostile takeover, then the CEO of the company gets a fantastic pay package. And in fact, this is something which happened in 1995, when in Walt Disney, the CEO was recruited, and his employment agreement mentioned a severance package of $140 million. what happened was in 14 months time, he was asked to resign, and he actually went away with $140 million in 14 months time. And there were a lot of litigations which happened on payment of this from the public shareholders of that company. But finally, the courts in US held that there is absolutely no problem with golden parachute. Similarly, crown jewel defense is something that is used internationally, where you just sell one of your crown jewels to any party at a huge discount, so that the company becomes unattractive for the hostile acquirer. Again, in India, the problem is selling of crown jewel is a restricted item under Regulation 26 of Takeover Code without the approval of the shareholders. But obviously, some of the things which can be used in India, for example, the brand pill is something which is used by a lot of Indian groups, like especially Tata's, where the license arrangement between the brand holder and the listed company terminates in a situation of a hostile takeover. And imagine, for for an hostile acquirer, if they don't get, let's say, just for the sake of example, Tata brand name, then what's the acquisition worth? So I think broadly these are the hostile takeover situations and the takeover defenses, which we have seen in global context and Indian context.
Let me come in here. This is Vivek. So I think Nishchal has given a very, very quick, very good masterclass on hostile takeovers, how they have happened in India, and how they can be defended both in India and globally. What are the traditional defenses? Actually, I'm in the current environment not so much bothered about general hostile takeovers, because I think capital is where it is. I don't know how many fair weather hostile takeovers will happen. I'm actually bothered that with the financial downturn, two things I'm seeing happening in the market and talking to promoters and companies almost every day on them. Number one, from a financing perspective, wherever promoters have leveraged themselves at their holding company level in order to buy shares in their companies, margin calls are starting to get triggered. So let's say I'm a promoter, I own 40% of my company, which is reasonably hostile takeover proof. It's not the 12-13% that the Mindtree guys had, for example. But against that, I have raised debt to either expand into new areas or to finance my holding or whatever. And when my share price is tanked, even if temporarily, the impact it has is it causes margin calls to get triggered, and therefore the lenders start selling my shares where they have a pledge. We've seen that happen partly in Z, not COVID induced, but just before COVID, where Z Entertainment being, even though it is such a attractive, profitable company, but because shareholders had invested in other infrastructure and other projects, margin calls started to get triggered, and the promoter holding companies weren't able to service the debt. So that's one. Two, from a financing perspective, there is just so much stress in the economy that lenders get the right in various situations. Even when it's corporate lending, sometimes promoters have given pledge of their shares and so on. So this is what is traditionally not hostile takeovers, but in this environment, I call it financing induced takeovers. And I think it's interesting to talk about them in the same bucket as hostile takeovers, because these are the hostile takeovers of bad times, of debt-ridden times like these. All that we hear is that the government will suspend IBC. I mean, a vast majority of IBC processes that have actually culminated have happened against the wishes of promoters. In other words, acquirers have been able to buy companies off the IBC almost in a hostile way, even though the courts regulated it, because the creditors were able to form a committee of creditors, take the company to IBC and sell the company. I think similar actions would get triggered in the current environment, and therefore, if the government were to say, let's say, defer IBC for 6 months, so long as they come up with a reasonable restructuring package, and I don't think the old circulars offer that framework, but if they were to come up with a reasonable restructuring package and force banks and lenders not to put the company on the block, I think we will prevent the COVID type of hostile takeovers. So that's the only additional limb that I wanted to bring to Nishchal's masterclass on hostile takeovers.
And I will add one bit here, that you are saying that how can the banks will be prevented from this. That recently you would have seen the case in the Futures Group case, where Future Group has pledged almost most of their equity, and banks were about to sell that equity, and the Future Group had gone to the court, and court had given them time, and they have stopped banks from selling it. And the next hearing will be, I think, in the next week or something like this. So that threat is a very real threat, because you see many promoters have pledged their major portion of equity for investment in other ventures or investment outside the venture. And as you see, the G has already, Subhash Chandra has already lost control of G. There is a likelihood that if the court does not stop banks from selling the equity, many promoters may lose the control of this. Now, the situation is that this is a commercial region, and whether courts can really get into it or not. Because if the court says that don't sell the equity now tomorrow the equity price becomes half or even 1/4 of whatever it may be, who is going to compensate the loss of the bank? Because the banks are not in the business of protecting somebody's control in a company. Banks are, it's a commercial transaction. I lend the money, the security is getting diluted, so I have got to act. So that is a very typical situation, a tricky situation where, because of the COVID, the promoters could be in a position of losing control. Now, I don't know how it can be resolved, because you cannot tell banks that you create further NPA because you have to save somebody. That is a very
Thank you, Mr. Gupta. And I think this is an appropriate time to switch to a topic that's related on M&A in this new world that we live in. Are we going to see special dispensation by the regulators in approving deals or disapproving deals at lightning speed? And I'll give you an example. When I was in Europe in the last decade, just around the time of the recession in 2008 and 2009, the Irish Competition Authority, which is equivalent to the Competition Commission of India, or the European Commission, the Directorate General of Competition, there were times where they were approving deals within a matter of days, as opposed to 30 working days or 210 calendar days, which the Competition Act provides. And so in competition jargon, we have a concept called the failing firm defense, where an otherwise anti-competitive merger or acquisition will be approved because the alternative is that the target company is going to go out of business. So to my panelists, are we going to see that in other areas such as SEBI, in the tax arena, with the other regulators that have direct or indirect oversight over M&A? Mr. Jayan Gupta, can I just start with you from maybe the SEBI perspective, whether you're going to see expedited approvals or disapprovals, and then we'll turn to Nishad and Vivek and Rukshad.
Mr. Khan, thank you. The issue is that, look, today what is the situation? Situation is this, that many companies would be finding that they are a sitting duck for being taken over by other people because of the low prices. Now, what happens? There are two aspects of it. One, whether we are going to facilitate it or we want to stop it. Now, if somebody wants to take over a company or somebody wants to take a stake in the company, the SEBI obviously has substantial acquisition and control SAST regulation, where there is a requirement to make an open offer. Now, the situation that has happened today, that if an unknown party wants to take the company, today prices being so lower, and I don't know what will be the average working out, it could happen that the outside party can purchase the shares and at a very low rate. Now, in order for the promoters to counter this, they have to increase their equity. Now, the promoters are not allowed to increase their equity beyond 5% under creeping acquisition route. Now, if they go beyond 5%, they have to make a open offer. So now you have a situation where if the promoter want to control, continue control, and want to ward off the hostile takeover bid, they have to also make an open offer if they buy more than 5%. So in a competitive open offer, because the promoters may not have as deep pockets as others would have, so they would be losing out. So one thing would be that there has to be some sort of a relaxation for the rules for promoters to increase their equity for the two reasons. One, in this presently, the business needs money, business needs liquidity. So if a third party is buying shares from the market, business is not going to get strengthened. So in order for business to get money, there has to be some sort of a direct issuance of equity. So SEBI may have to look at a situation where they will allow promoters to increase their equity and part of the thing. Other thing would be that in a situation where the company is in really bad shape and the promoters cannot bring money, then the problem happens that any person who is coming to control the company or buy the company will have to give open offer to for the entire 26% more shares. Now, which in present situation may become very difficult because as it is the person wants to support. So the thing plays both ways. Now, what SEBI going to do, I do not know, but I think SEBI is not going to completely do away with the takeover code. So SEBI will have to be taking a very cautious approach because, and third thing is this, that one has to realize that this situation is not a permanent, as Nischal very clearly guided that there could be 3 sectors on this. So this situation is not permanent. It is 3 months or 6 month situation. Now for 3 months or 6 month pain, why somebody should be losing the company which is created for 30, 40 years and which he has been managing? Because it is not a case that only badly managed companies have lost value. It is all the good companies have lost value. So we will have to find a middle path somewhere.
Yeah, maybe I can take up for the regulators. So I think my take is, I think we are at a juncture where we don't have an option but to get our act together. And I would say, beggars are not choosers. So clearly, as I mentioned, the only two capital flows that we have is one from the government and second is from the foreign investors, because Indian corporates are going to preserve cash to survive. Indian institutions like PF authority, insurance companies are not allowed by government to invest too much, from a risk perspective. So the key would be, how do we manage to attract foreign capital into India? And if you ask me, I think it's not it would be a question of survival for the government, where if they don't get their acts together and expedite the approvals from the regulators, it's going to be that foreign capital is going to find ways into other countries. And I'll give you a simple example. This is much before COVID. In 2019, we did one insurance transaction, which was it was a $1 billion deal. And we were actually surprised as lawyers because we had never seen this, and I'm sure all of you also would agree to that. We got CCI approval in 11 days for a $1 billion deal. We got RBI approval in 3 days, and we got approval from IRDA in 7 days. Now, this is completely unheard of, but I think the lesson to be learned from this is, if our regulators want to do, they can easily get some of these things done, and especially since the number of transactions are also going to reduce, right, over the next 6 to 12 months. There is no reason why we can expedite some of these approvals both at CCI level or RBI level or the sectoral regulator level. So I think it's just a question of mindset, how we want to take this, and if we decide to do it, then it should be a cakewalk in my view.
Analysts, any other thoughts on that topic?
So points I'd like to make, Babu. Thank you. One, I completely agree with Nischal. if regulators indeed want to support a transaction, they can. The good thing, and I will say one good thing and one bad thing. The good thing that I'm seeing in my interaction with the government through chambers of commerce and industry or otherwise on behalf of our clients is the government is very willing to listen. So even at this time when it's hard to get, when it's impossible to get physical meetings and we are interacting over such mediums, I think the government is listening and suggestions that are being provided by industry are being heard. So that's the good part. The bad part from a tax perspective is our tax laws are written up not not in a very, let's say, normal way, in the sense there are a lot of provisions in our tax laws where we are trying to plug loopholes. So this entire section 56(2)(7), 56(2)(10), where the starting out assumption is that any deal that has been done must have been understated, that there must have been some other consideration that's passed hands. And it's up to the acquirer and the seller to keep proving that no, our independent third party deal is at a full price. I think that has caused a lot of heartburn in deal making, particularly to international investors who haven't seen such legal provisions in other countries where they do deals. I mean, imagine you're doing a deal under IPC, under a court-regulated process with a committee of creditors approving your deal, and then if your price is lower than the listed traded price, or if your price is lower than the income tax fair value price, then you get docked. And oftentimes equity in IPC companies, as we all know, are worthless. So the bad part is our laws historically contain a number of what I call bureaucratic overreactions to some Indian cleverness. That is where I think the government needs to spend effort. And while I agree with Nishal that they will accelerate processes, I don't think they will still use this COVID opportunity to clean up those kind of suspicious provisions from our statutes. And because I dabble in tax, therefore I'm highlighting to you tax provisions. But whichever regulation one picks up, it is replete with instances where an over-suspicious bureaucrat has inserted a somewhat not so logical loophole plug.
All right, thank you, Vivek. So, ladies and gentlemen, we're coming to nearly the end of our time here. So I think we're going to bring this to a close very quickly. The one thing I always like to do in webinars is ask our panelists, who've been wonderful and actually given me a lot of insight on what the future is going to hold on M&A. I'd like each of them to tell us in 1 minute or less, because I think we have exactly 5 minutes left on timing. What's the one thing you want the audience to take away? So let me just start with Rukshad. 1 minute or less, what's the one thing you want our audience to remember today? And then we'll go to Nishal, Vivek, and then we'll give Mr. Jayan Gupta the last word.
Sure. So as I mentioned earlier, the landscape is going to change considerably in terms of deal making in India, in terms of it being now a buyer's market. So valuation and liquidity are going to be the key drivers. But the silver lining is that there is going to be reduced cost of capital and more realistic valuations, which will drive up M&A activity to an extent. And also in terms of contractual protections, there's going to be to an extent a lessening or tapering off of indemnity obligations given the risk averseness in transaction, which would be substituted by a rep and warranty insurance going forward.
Thank you. Nishal, you want to take it from there?
Sure. So I think from my perspective, the level of M&A activity in the next 6 to 9 months will depend on how the government reacts to the situation, especially attracting foreign investment. So if the foreign investor is coming to the Indian government and saying, I want to give money to you, and the Indian government is saying, sure, why don't you give me money, but why don't you follow this 10 processes before you give money to me, it's okay if it takes 3 months, 6 months. Then that foreign investor is going to find some other country to invest in. So I think the entire M&A activity or investment activity in the next 6 to 9 months is going to depend on how the government is going to react. And while we heard a couple of days before, our Prime Minister had held a meeting to see how to entice global companies who want to quit China and set up their operations in India. But I think what needs to happen is, it needs to percolate down to the last level within the government departments. While, we have seen time and again that at the top, there is a lot of inclination to get some of these things done. But when it comes to people at the bottom in the government department, that's where the pain starts. And somewhere we need to ensure that right from top to bottom, everybody is aligned and working with the sole aim of getting more foreign capital into India, which in turn will increase the M&A and PE activity in India.
Vivek?
Okay, so 2 sentences only from me. I think these are painful times for M&A. I don't see much activity regardless of what the government does in the next 6 months, because the environment itself is very, very uncertain. So I'm less bothered about predatory takeovers. I'm more bothered about survival today. Survive for now. We can thrive in M&A after 6 months. That would be my takeaway for the session.
In fact, just to add to what Vivek said, Jack Ma of Alibaba made a very interesting statement that 2020 is the year for survival. Forget about your dreams and targets for 2020. As long as you are alive and you are surviving, that's what matters in 2020.
So see, Jack Ma and I think alike.
And I wish you become as successful as Jack Ma. Okay.
Mr. Gupta, the last word.
So I would say I agree with Vivek that this is the time where the first thing is to survive and protect yourself and at least maintain the space which you have been enjoying for long. The second phase will start a bit more based on what and how long the anti-China sentiment continues and whether it really takes shape or not. If anti-China sentiment dies down, then I don't think there is going to be much change all over the world. But if anti-China sentiment continues and people continue with the thing that now business continuity plan has to change and it has to be rewritten, then probably lot of activity change take place not only in India but many emerging markets which would be able to shift business from China. So that will be mainly.
All right, panelists, thank you so much for that. And
Also, Baku, before you close, I'm going to become the moderator now, and I'm going to ask you for your take in less than a minute, or what your takeaway for the session is.
Fair enough.
Now, you're already behaving like Jack Ma.
Fair enough. My takeaway is this: is that there is a real international tragedy going on here. I do think that there are opportunities to make the best out of frankly, a terrible situation. The United States is still going through this. And for example, I'm in the Bay Area, so I've been in an official lockdown from March 17th, and it's continuing all the way through May 31st. That's 10 weeks that we will have been on lockdown. And what I'm hearing is that that's not even close to being enough, that this is the new norm. This is going to continue. And I think there's going to be a lot of adjustments that have to be made. But I'm perhaps maybe a little more optimistic than some people in thinking that maybe we'll see a rise in international cooperation to avoid something like this from happening again, where the governments of all the countries get together to avoid this. So perhaps I'm maybe naively optimistic, but that's the one takeaway that I see, is that there are ample possibilities for silver linings. And the question is, are we as humans, as Indians, as Americans, whatever we are we willing to take those up? And so with that, Manoj, I'm going to turn the program to you. I want to thank the panelists. I have found this remarkably fascinating, and it's 6 o'clock in the morning here, and I'm just ready to go. So, Manoj, question for you. Do you want to open it up for questions to the audience, or how do you want to finish it?
No, we do not have time to take questions, but if they have any questions, they will send it to me and I'll circulate among all the panelists so that we can then give them the replies. Now, let me thank Mr. Paku and all the panelists. And as Mr. Vivek Gupta lightly said, okay, my views and Mr. Jack Ma's views are same. So to extend that corollary, today Tata Motors turnover, Mahindra's turnover, Gujarat Ambuja's turnover, and my company's turnover is same. With
Maybe
this
you will have more turnover than them.
with this note, I would like to invite our new guest on the panel, Mr. Vishal Doshi, who is the Vice Chairman of WRC ICAI. Vishal bhai, thank you very much for taking out time from your busy schedule and joining us here. I must thank WRC ICAI for giving us this opportunity by joining our online fireside chat series. Over to you, Mr. Vishal. Thank you.
Thank you, Manoj bhai. In fact, it is a privilege for WRC to be associated with the Bombay Chamber of Commerce and Industry. And let me tell you, it was an amazing panel discussion. So my thanks on behalf of BCCI and the WRC to Mr. Khan, Mr. Gupta, Mr. Vivek Gupta, Mr. J.N. Gupta, and Mr. Joshipura. It was indeed a very, very amazing. It was a very, I would say, knowledge gathering panel discussion that was I witnessed. Friends, I was just, we were going through the sessions and I understand that the 4-day series has been dealt with on different topics. The fireside chat series on corporate compliances in a renewing economy, the board of directors as a custodian of sustainability post COVID-19, protecting directors from legal liabilities for involuntary financial defaults, and new norms under the M&A, which was today. Friends, my take on the current situation on the corporate governance side, I would say that it is very, very important for the independent directors and the role of the board committees in the current situation, especially with each and every committee, I would say, be it the audit committee, the risk management committee, the stakeholders relationship committee, the CSR committee, and the NRC. Each committee has a very, very important role to play in the current situation. I can actually go on to narrate, what the responsibilities under COVID-19 for each committee can be. But most important, ultimately, for the companies would be that they should not at all compromise on the culture, the values, and the mission and vision with which the company has been set up. And these are the times that there might be some revisiting which would be required on the various counts of the business strategy, the long-term strategy of the companies, and how they would adjust to this pandemic. My firm belief is that that we are actually in a tunnel. It seems like we are in a tunnel, and we don't know how long the tunnel is, and that is what is the scenario today. And so it is very important that the corporate governance culture of the country is kept afloat. And I believe that at least the corporate governance should not die from Corona. That is my take on the subject, since they were all the corporate governances that were most of the topics were relating to that. So once again, I thank Manoj bhai, the BCCI, for coming together with WRC, and on behalf of WRC, I look forward to more such online webinars and maybe even physical seminars jointly in the future. Thank you all.
Thank you.
Thank you, Vishal bhai, for your wonderful speech. I now invite Mr. Vijay Srirangan, Director General of Bombay Chamber of Commerce and Industry, without whose help this seminar could not have happened. He has given us, extended us full support, cooperation, and guidance for these 4 sessions in this online fireside chat series. May I now request Mr. Vijay Srirangan to do the needful, please?
Yeah, thank you, Manoj Bhai. I'll make it short and sweet. First of all, thanks to Sri Vaid, President of the IMC, for his keynote speech. He used examples of M&A historically to set the tone. Thanks through Sri Khan for moderating different perspectives on the subject, both target and buyer oriented. And he set the tone for very vivid discussions that followed. Thanks to all the panelists, Sri Davar, Sri Gupta, Sri Mr. Joshipura, Sri Jayan Gupta, for bringing both functional and contemporary COVID, post-COVID scenarios into deliberations. Of course, I have to thank Manoj and team for conceiving and organizing the last 4 days, a job, in my opinion, well done. Many thanks to WIRC of ICAI and the Vice Chairman Vishal, who just spoke, for being joint organizers, to my colleagues at Bombay Chamber for assisting in taking this forward. Thanks to Hiral Bhai Shah and Sejal Ben Shah, without whom this seminar could not have been set up and running smoothly, and to Intuit Consulting for joining as knowledge partners. As is my wont, I will end with 4 lines of verse on 2 different subjects. Permit me to read them out. One is on the merger and acquisition subject, and the 4 lines of poetry go this way. Mergers and acquisitions have always been a subject of interest, yet COVID-19 has given rise to some who are proclaiming, oh, Mars. The landscape discussed today represent both an opportunity and a test for actions that provide more wah accolades than ye kya huas. So that was the section on M&A. The second one on combination of different groups, and those read this way. Though not a merger, this series does show how different groups may come together. Involvement, participation, and solutions can grow to improve navigation through the current weather. And with those 4 lines, I bid you good day, good evening, and good night.
Thank you.
Thank you, Mr. Vijay Srirangan. Thank you very much for your nice poetry also, which we really relish and cherish all through for the sessions. Once again, on my personal behalf, on behalf of Manoyog GRC Advisors, on behalf of BCCI, that is Bombay Chamber, on behalf of WRC ICAI, and on behalf of Intuit Consulting Private Limited, I thank all of you, of all participants, all speakers and panelists, moderators, especially Hiral Bhai and Sejal Ben for putting up all these technicalities to keep this webinar smooth and running. Thank you, Hiral Bhai, once again. Thank you, Sejal Ben, for your kind efforts and your all-out efforts, rather. Thank you very much once again. I officially announce this series to get over today. Thank you very much.
Thank you.
Thank you.
Thank you.